A war intensifies, an election hints at what lies ahead, a startup darling goes bankrupt, and a king lays out his commitment to fight inflation. This is Bloomberg Wall Street Week. I'm David Weston. This week, Nobel Laureate Michael Spence on the promise of generative AI.
Generative AI is mainly, not exclusively, but mainly going to turn out to be a powerful digital assistant.
RockCreek's Afsaneh Beschloss explains how to make money investing in climate in China.
While a lot of countries in the West talked about it, the Chinese actually became more than 80% of solar.
And Melissa Kearney of the Aspen Economic Strategy Group on building economic resilience by addressing the deficit.
It's important that people are now paying attention to this. I mean, we're really on an unsustainable path.
Global Wall Street spent another week watching Israel's war with Hamas unfold as Israeli forces surrounded Gaza City and the fighting intensified.
Ground operations by the Israel Defense Forces and continued bombardment are hitting civilians. At the same time, Hamas and other militants use civilians as human shields and continue to launch rockets indiscriminately towards Israel.
And the United States joined much of the rest of the world in calling for a humanitarian pause.
I don't think, Israel is interested in a ceasefire at this point, but they are perhaps willing to have what we do call humanitarian pauses.
Off-year elections in Ohio, Kentucky, and Virginia tipped decidedly toward the Democrats.
What's fascinating about this series of elections and the ones we had in November of 2022 for the midterm election is that they're saying the same thing.
Suggesting maybe that abortion rights could play a role in the presidential election less than 1 year away.
If you look at from the midterms to last night, from California to Kansas, Ohio to Virginia, the voters said, look, the government should not be telling a woman what to do with her body.
In 2 short years, the real estate startup WeWork went from a huge potential IPO to a SPAC to bankruptcy, costing billions in the process.
As a company, we need to accept this reality and also need to learn the lesson from this for our future investment activity.
On Wednesday, the picket lines came down in Hollywood as the studios reached a tentative agreement with SAG-AFTRA, raising hopes that movies and TV shows would get back into production.
This sends a very clear message that unions work, labor movements work.
And no less than the King of England weighed in on the need to fight for an economic soft landing.
My government will continue to take action to bring down inflation, to ease the cost of living for families, and help businesses fund new jobs and investment.
And then, after the equity markets closed on Friday, Moody's cut the U.S. credit outlook to negative as the country looks at yet another government funding deadline next Friday. Through the week, the bond market was on something of a roller coaster, with the yield on the 10-year ranging as low as 4.47, and then it shot up again late Friday after the Moody's news to end the week at 4.65. Stocks were a bit more upbeat as the S&P 500 added another 1.3% to come within 30 points of the year-end median number of 4435 that our Bloomberg elves are projecting right now, while the Nasdaq gained nearly 2.4%. To explain it all to us, we welcome back now Sonal Desai. She is Franklin Templeton Chief Investment Officer for Fixed Income. Sonal, thank you so much for being back with us. So before we get to what happened overall in the week, what about there right at the end on Friday with the Moody's downgrade of U.S. credit? How material is that?
So, material, if we're talking about, does it have an important impact on people's desire or ability to hold U.S. debt? It's not going to be so important. But as a signal of how dysfunctional the U.S. policy making is right now, it's very important, I'd say. I mean, it's a reminder that we are looking at an extremely serious fiscal problem between the debt and the deficit. And the way we are operating right now is not very reasonable. So it's a good reminder that fiscal policy is an issue, and markets should pay potentially more attention than they are to fiscal issues.
And it comes against the backdrop of a fair amount of volatility in your neck of the woods, that is fixed income. We saw again this week the ups and downs. They may not have been quite as big, the amplitude may be a little bit less than it has been, but it's still a fair amount of volatility because I'm not sure the markets know where it's going.
I think that actually, if you look at what's happening with markets, what we saw last week really was once again, we've been to this show, David, right? We've done this before many times over the last year and a half. You have a Fed meeting, the market hears what it wants to hear from what the Fed is saying and runs with it. So what I think that Jay Powell was trying to do, not this week, but the week before, was to give the market a gentle nudge in the direction of a slightly more dovish message. The market took that slightly dovish message and simply ran with it. We had a close to 40 basis points rally in the 10-year on the back of the Fed, on the back of slightly different than anticipated schedule from Treasury in terms of issuance, and a slightly softer job market report. The three of them together do not change enough of what's happening on the ground to justify the type of rally we saw. And indeed, this week we've seen a bit of a sell-off, that roller coaster you were talking about. I think the market's still really, really focused on trying to figure out whether the Fed or the Treasury can swoop in and make it all okay again so that rates can rally and we can go back to the races.
Given that situation, Sonal, what's an investor to do? How do you try to protect yourself and actually make some money in this environment right now? Cash is actually worth something now, or near cash is worth something. But what do you do with your bond portfolio? Let's talk about that specifically.
So actually, you're right. Cash has been very good for people this year. You're getting a very good return on cash. However, as we get towards the end of this year, I said that I've been saying for a while that the Fed is likely to maintain higher rates for somewhat longer than the market is anticipating. We're not getting ready. We are certainly not forecasting 100 basis points of rate cuts starting already from the middle of next year, as is being now priced by the market. Nonetheless, as we get towards the next several months, I think the time to start moving away from that very, very short duration and cash and fixed income, it's coming. Because we are looking, once you get 10 years at round 5, once you look at high quality investment grade credits and mortgages, areas like this are yielding over 6%. These are actually pretty attractive yields to start slowly averaging into a little bit of duration, is how I would put it. I don't think we chase the yield because the type of volatility we've seen, it's not gone away. I do think we're going to probably see 5 again. So there's time to start factoring that in, but averaging in a true fixed income portfolio where you start adding a little bit of duration, it's a good idea to do right now, around now, over the next 3 months, over the next 6 months. And I'm looking forward to fixed income actually playing that traditional role of delivering income rather than equity-like returns. Looking at next year, I'm not looking for massive capital gains out of fixed income.
What about outside the United
States?
What about outside the United States, Europe, Japan?
So that's a really interesting point. So in Europe, we actually think that the underlying growth fundamentals make duration plays in Europe potentially more attractive even than the US. So that's one area, because growth in the euro area is simply not as well supported as it continues to be in the US. We're slowing in the US, but we're starting from a very good place. Japan, to me, is the really fascinating one, because Japan and Japanese investors have actually been a major source of support for the long end of the US yield curve, because rates have been so low, and Japan within the G3, the BOJ is very much behind the Fed and the ECB in terms of changing its monetary policy stance. So I think that over the next 3 months, next quarter, 3-4 months, we are going to start seeing a change in policy in Japan. And that potentially is going to start making the yen look quite attractive. The yen has sold off. It's at close to record lows right now. We're at around 152 yen to a dollar. Great time to go visit Japan. It's cheap for once. But having said that, I'd say that looking forward into the next 3-4 months, we actually do think that the BOJ will ultimately be pushed towards changing its own interest rate stance, which would bring money back. There's a lot of Japanese money which is currently invested in the US, and some of that will go back.
Fascinating. Governor Ueda so far has not indicated he's going to do that, but maybe we'll go that way. Thank you so much to Sonal Desai. Always great to have you with us. She's from Franklin Templeton. Coming up, what generative AI will mean for our jobs and whether we get to decide. From Nobel Laureate Michael Spence of Stanford.
You can influence the direction of technology and development, and I think, with incentives and so on, and it should be influenced in the direction of collaboration and augmentation.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. We know it's coming, and we're told it's going to be big, but what generative AI will mean to our economy and our lives is yet to be determined, including what it will do to jobs and productivity. For his analysis, we welcome now Michael Spence. He's Nobel Prize winner in economics, Dean Emeritus of the Stanford Business School, and co-author with Gordon Brown and Mohammed Al-Arian of Permacrisis, a plan to fix a fractured world. So, Dr. Spence, thank you so much for being with us. You've written an article, co-authored an article in Foreign Affairs, specifically The Coming AI Economic Revolution. So you've thought through these things. First of all, start with what the challenges are that we have in terms of size of workforce and productivity that perhaps AI could help us on.
So we have a lot of what we call secular headwinds to growth. So we lived for 3 decades, David, in a world that produced massive amounts of incremental productive capacity, mainly in the emerging economies. As a result, we had a deflationary kind of, pattern in the economy. If inflation wasn't much of a problem, and all that. That force is fading rapidly. And then you've got aging in the global economy. More than 75% of the global economy is in a serious pattern of aging. Declining workforces in some cases. You have big changes in labor market behavior. You have shortages in all the major employment sectors in the American economy, the big ones. And then you have geopolitical tensions and shocks coming from multiple sources like pandemics, climate, and a pattern of diversification initiated both by businesses, in pursuit of kind of resilience and longer term, profitability, but also now by economic policy in multiple jurisdictions. And when you combine all those forces and the declining productivity trend, which has been fairly dramatic in the last decade, that you've got a world that switched relatively rapidly from, demand constrained to supply constrained growth patterns. And so we're looking for solutions to the supply side issues that are creating not only problems for growth, but problems for the reappearance of inflation, for higher interest rates, lower valuations, higher costs of capital, and so on. And we're doing it in an environment where we have to make enormous investments in things like sustainability. So it's when I stand back and look at it, it's a big challenge, and so that led me and others to try to start looking for, what tools and technologies do we have to try to solve this problem?
We all lived through something of a digital revolution in the late 90s into the early aughts in the move to the internet, and there was a real growth impetus from that, as I recall. In what ways does this new move to digital revolution through AI compare to that? Maybe it's similar to or maybe different from?
So we did get a productivity surge. It came, in the late 1990s after everybody got access to the internet and the World Wide Web came in, into its own. And that lasted into the early 2000s. And some of that is ongoing, the digitalization of supply chains and so on. That was pretty powerful, and it had noticeable effects. It produced a decline in middle class jobs in the advanced economies like ours. It produced what David Autor calls job and income polarization. There was a lot of automation in it. We automated things like, the keeping of the general ledger. Most of the information systems that a corporation runs on are now sort of digital and fairly automated, and so on. So, it was powerful, but it feels, to me at least, very different from the current round.
One of the things you point out in your paper in Foreign Affairs is the effect that this new generative AI could have on so-called knowledge economy, which is different from the automation you referred to from the internet. That may well affect a different strata of jobs, as I understand it.
Yeah, I mean, the knowledge economy, when you think about it carefully, kind of runs through and across the entire economy. So even in what we think of as sectors that are sort of largely blue collar, there's a fair amount of knowledge, that goes into these things, skills, knowledge, and so on. I mean, take something like nursing. Nurses are pretty highly trained people. They have to respond in intelligent ways to the signals they get from, the equipment that patients are using and that they're looking after, and so on. But yes, I mean, the CEO of Google, when asked, where is this going to have its immediate impact, it's going to be in the knowledge economy. But I think, we tend to think of that as sort of white collar work. And there's an element of truth in that, but I think it actually does run right across the entire economy. Maybe not to the same depth in every sector, but nevertheless, it's very broad-based.
Do we have a sense, and I understand this may not be determinate, I mean, that is to say it may differ based on what we do, but do we have a sense of the extent to which this generative AI will displace jobs, they will go away, as opposed to transform jobs?
Look, I mean, we're in a period of intense exploration and experimentation. So, people often say, that it's important to acknowledge, real uncertainty when you're in the early stages of this. And that's certainly characteristic of this. Having said that, James and our best guess is that generative AI is mainly, not exclusively, but mainly going to turn out to be, a powerful digital assistant.
One of the points you make in the paper is that, as I say, this is not predestined. To some extent, how this ends up depends upon us and what we decide to do about it. Explain to us about what you think needs to be done or should be done so that we get the most good out of generative AI. And as a subpoint, how much of that can be trusted to the markets as opposed to governments?
So, I think the markets and government and attitudes and biases, are all part of the mix. So I think the first order of business is to avoid what Eric Brynjolfsson calls in an influential paper, the Turing trap. So Alan Turing proposed that we evaluate progress with digital machines by using the following test. Can we build a machine that interacts with a human and the human thinks that it's interacting with another human? It's a fairly small step. And this is common in the AI world, to evaluate progress in AI by determining how well machines do relative to human performance. So we do that in language recognition. We do it in image recognition, which is a huge breakthrough in the last 6-7 years. And we do it, with generative AI. Does the generative AI do better than the average human on the LSAT, the law school aptitude test? That's okay. But there's a very small step from that to thinking that, once the machine passes the human, why don't we get rid of the human? And that leads you to what you might call the automation bias. And that, I think, we do have to resist. And that's not government, that's not business, that's not any particular sector. It's just the way we think about it. So I think that's step one. Step two is, you can influence the direction of technology and development. And I think, with incentives and so on, and it should be influenced in the direction of collaboration and augmentation. And then third, with the way James and I thought of it, we don't want to repeat that pattern of, sort of high adoption rates and very low adoption rates that we saw in earlier rounds of digital, adoption. And so there, I think the government has a very distinct role to, to at least think carefully about programs and activities that, increase the likelihood of diffusion across the entire economy to small and medium-sized businesses. And for me as an economist, this is not just a nice to have or a distributional issue. If we believe there's a potential productivity surge for the entire economy, we're not going to get it, if we can count on the fingers of one hand the sectors that have moved ahead in using this. So I think it's important from a kind of macroeconomic performance point of view to think carefully about what we can do to maximize this, sort of accelerate the diffusion and adoption rates across the economy.
Dr. Spence, thank you so much for being here on Wall Street Week. Really appreciate it. That's Dr. Michael Spence of the Stanford Business School. Coming up, as we count down the months until next year's elections, our colleague Michael McKee takes us back through what happened to some other incumbent presidents when the economy was in flux. That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. This week we watch off-year elections across the country, in part to see what they might tell us about what will happen next November. Bloomberg International Economics and Policy Correspondent Michael McKee takes a look back at earlier challenges to incumbent presidents and what roles the economy and the Fed played in deciding whether they would keep their jobs.
Joe Biden, George Bush, or Ronald Reagan? His polls now, a year out from the election, are terrible, but you can't write him off. Two examples, both presidents from the other party. One also deemed doomed a year from the election, and one who couldn't lose. Both proved a year is a very long time in politics and the economy. As Reagan geared up for re-election in 1983, he was coming off the second of two recessions, his approval rating well below 50%. Unemployment was 8.8%. The misery index, combining unemployment and inflation, 11.7%. The Fed's target interest rate was 9.5%, and mortgage rates 13.4%. A year later, it was morning again in America.
It's morning again in America.
Reagan won 49 of 50 states. Then there was George H.W. Bush. A year before his re-election campaign, his approval rating was 66%. Coming off his own recession, unemployment was down, the misery index was down, the Fed was at 5%, and you could get a mortgage for 8.8%. A year later, Bush lost to Bill Clinton. The difference? Under Reagan, the numbers were high but coming down. Under Bush, the opposite. So what to make of Joe Biden? His data are much more mixed. Unemployment just 3.9%, still near a record low. Inflation 3.7% and falling. Yet the Fed's target rate is 5.5%, a mortgage is 7.8%, and Biden's approval rating is just 37%. But a year is a long time in politics, as we've seen, and a lot can change. The one thing we know won't change, to quote Bill Clinton, for voters, it's the economy, stupid.
Thanks to Bloomberg's Michael McKee. Coming up, investors have lost some enthusiasm for China and for green projects. But might things look more attractive if we combined the two? We ask Afsaneh Beschloss of RockCreek.
If you can find companies that are well run, that are profitable, I think it's a great area just because they are very good. But you have to be very careful.
That's next on Wall Street Week on Bloomberg.
China and climate investing, two destinations that were once all the rage.
If I had to bet on one market or the other over the next several years, I would bet on China's.
If you're a global investor, you've got to be watching and investing here in China.
ESG investing has gone from niche to mainstream.
We're integrating ESG
environmental, social, and governance into every aspect of our investment decisions and across our investment portfolios.
But that recently have given up some of their momentum as foreign direct investment in China has dropped off.
The big question will be whether Xi Jinping pivots and focuses more on market opening and creating the confidence and the conditions to continue to attract foreign business, which is necessary if he's going to continue to grow his economy. He can't do it without foreign business being present.
And green investing has gotten increasingly controversial.
The energy transition is very much misguided, in my opinion. It's based on politics and emotion. It's not based on science and fact. All we're doing is we're substituting one form of mineral extraction for another.
But now there's reason to take a second look, as technology may be taking the place of real estate in the Chinese economy.
Yes, there are excesses in parts of the Chinese economy in real estate, but their technological prowess is really strong. The entire clean energy economy cannot exist without Chinese components and Chinese raw materials.
And China races ahead of the West in extracting the minerals that drive the move away from carbon.
China's been developing this industry for 20 or 30 years, so they're really ahead of most Western democracies. It's now important for us to make sure we have diversified supply chains, because no matter what the product, whether it's critical minerals or rare earths, having options around where you get these things are going to be really important.
Leading Western investors to take a second look at parts of the Chinese economy that may be opportunities even as other parts slow down.
What I would say is I think the story on what's growing in China is actually misunderstood, right? One is that housing, I think people know that it's not growing, and I think that's been well documented. What they're missing, though, is the growth drivers. What you're seeing is a huge growth surge in the decarbonization or the energy transition.
And to give us her sense of investing in China and investing in green at the same time, we welcome back a very special friend of Wall Street Week. She is Afsaneh Beschloss of RockCreek. Welcome back. Great to have you, Afsaneh.
Thank you, David. It's great to be here.
So in general, you hear people are less enthusiastic these days about investing in China. And even in the area of climate investment, there's some question about that. ESG is very political. EVs are not as popular. But what about investing in climate in China?
So you're absolutely right, David. Investing in China, you put it very nicely, but I think a lot of people are taking out their money from China. We've seen now from FDI going down to equity flows going out to companies repatriating their profits in China. And a lot of people are actually not even making overt noises that there are because they want to build the next factory somewhere else before they say they're taking it out. So I think, if anything, what we've seen is the beginning of a process of reducing outside money going into China. And of course, the biggest problems, we've talked about this before, is the demographics, the big loans that the banks have, and also the fact that people are still saving so much and not consuming. And that has not changed. Even yesterday's numbers showed there's deflation in the consumer area. So coming to the whole area of green energy, interestingly, while a lot of countries in the West talked about it, the Chinese actually became more than 80% of solar power production. When people talked about EV, they're now 50% of EV exports into the world, apart from also buying EVs in China. So there is this contradiction in the broader economy in China. And I think while we are still discussing whether there is, ESG or whether we should have renewable energy or not, they're not really looking at ESG. They're just looking at economics. They're looking at the fact that these EVs and solar energy is cheaper. They are big. They have huge reliance themselves on imported oil and coal. So from their own point in terms of geopolitically, they have made a bet. Plus, when they went to all the COP meetings, they heard loud and clear that the West is talking about this. The interesting thing is they did more than the West in terms of investments in this area.
So, Sonny, on this program, before you've said it's the second largest economy in the world. You can't talk about just ignoring China.
Yes.
You have to deal with China. So if you're going to have to deal with China as an investor, some of the issues you identify are directly or indirectly tied to the government. Even consumer purchasing, in part, is because of a loss of confidence, it appears. Certainly in the tech sector, because of what the Chinese government is doing. But given what you just said about climate, is that a relatively safer sector because the Chinese government is so committed to the area?
So Chinese government is committed. It's still continuing to invest a lot in this area. But at the same time, as Janet Yellen said in her piece yesterday, they're also subsidizing a lot the energy sector. So what they have done with new sectors, as China has entered any new sector, whether it was originally tech, whether it was infrastructure, whether it is now clean energy, huge subsidies going into it. So if you can find companies that are well run, that are profitable, I think it's a great area just because they are very good. But you have to be very careful to invest in companies that are really riding the low wage, the subsidized wage and subsidized loans from the government.
And given what's gone on with the stock market over there, do you want to look at private companies rather than publicly traded companies?
So I think maybe a few years ago, yes. But I think in private investments, the biggest issue is the rule of law and certainty of whether you can take your money out. If you invested today in a private investment, you would assume you're taking your money out maybe 10 years, maybe later. So I think what the environment that President Xi has created, unfortunately, makes people much less comfortable making private investments. If anything, Chinese very successful private investors and tech and venture investors are starting to invest much more in Chinese companies that are investing outside of China or in Japan, because they are concerned themselves that if they become too successful, the fate of Jack Ma and others may fall on them. But also, if they're not super successful, then what's the point? So the entrepreneurial spirit, which has been super important, really, in the last 20 years in China, particularly the last 10 years, I think that is waning. And it is, I think, something to really watch for any kind of investment in China.
Talk about more globally. We have COP28 coming up at the end of this month now. And there are discussions going on even as we speak. This week, there were discussions between the U.S. and China to try to come to terms on some basic issues, including funding for some of the lower income countries to be able to deal with it. If, in fact, and it's a big if the United States and China could come to terms, if COP28 could come up with some meaningful global, really, agreements, would that be an investment opportunity potentially? Because it could really jumpstart a lot of the green economy.
I think it would be really, really helpful if there was agreement. And I think starting with next week's meetings, the APEC meetings here, with a lot of Asian leaders in the U.S., that will be sort of the start of those conversations. And I think we should watch those to see what kind of agreements or lack of agreements there are next week in terms of climate, because that is military and climate are the two areas that people are looking for different kinds of agreements next week. So if that happens, I think we can be hopeful that when we get to COP, there'll be a more positive environment for some sort of agreement. My sense, though, is that the economics of renewable energy has changed a lot. So if you look at it, for example, on any given day in Texas versus California, one is ahead of the other in terms of solar production of power. So that is all based on economics, not politics, of ESG or all the other words that we hear. So if we're taking that line, if we're going to a lot of other countries, you're seeing that people want to move to EV cars just because they're cheaper at the moment in terms of running them. So if you look at that, it will be the consumers, it will be the private sector that I think will be bigger leaders in this. Public sector leaders have not really been, while lots of speeches have been made, have been less helpful in terms of executing. And of course, sorry to go on this point, but the big issue in the U.S. will be the IRA versus what happens in COP, really.
Well, IRA, I want to pick up on exactly that, because the theory of IRA was we'd have public investment that would trigger private investment. It would leverage. Go globally right now. It might make more economic sense to invest in green energy, but that's if you have the money to invest. There are a lot of countries around the world, the lower income countries, who just don't have the money. Everyone seems to agree that we need to get the money for them. There is a fund that's set up that, as I understand, has no money in it right now. Let's assume, again, a big if, that got funded. would that create actually private investment opportunities as a lot of these lower income countries have to rapidly invest in green?
Absolutely. I think these countries that you're talking about are growing faster. Some are poorer, some are less poor, like India and China, as we talked. So they will be the largest users of energy moving forward. They will be building a lot of power plants. So they have the choice to go coal, oil, gas, or renewable energy. And a lot of them are sitting in areas that are very sunny. If anything, are getting more sunny and more hot. So having solar energy for them is the cheapest. And their issue has been exactly as you said, the fact that there is no risk mitigation system to lend to them.
Afsaneh, always wonderful to have you on Wall Street Week. Thank you so much. That's Afsaneh Beschloss of RockCreek. Coming up, building a more resilient economy. We talk with Aspen Economic Strategy Group Director Melissa Kearney about the subject of this year's meetings.
These reforms really need to have bipartisan buy-in so they're lasting.
That's next on Wall Street Week on Bloomberg. This is Wall Street Week. I'm David Weston. Building a resilient economy. That was the subject of this year's Aspen Economic Strategy Group meeting this past summer. And now we have the tangible results in a monograph published just this week. We now talk with the Executive Director, Melissa Kearney of the University of Maryland, about what we learned. So, Melissa, welcome back to Wall Street Week. Great to have you here. So,
thanks so much for having me, David.
First, give us the overview of what is covered in this monograph, because it covers a fair amount, but it all has to do with building that resilient economy.
We remember it's a bipartisan group, the bipartisan Aspen Economic Strategy Group. We're really excited to be putting out this volume. It does cover a lot, as you said. There's 8 chapters, all by leading experts from around the country, taking up issues of important economic policy challenges facing the U.S. And we segment the volume into 3 sections, all focused on the overarching theme of building a more resilient U.S. economy. And the first topic we take up is the need to get our fiscal house in order, addressing the high level of public debt, the rising share of the federal government's spending that goes to paying down interest on the debt. All of that is really critical to building a more resilient fiscal situation. And of course, to tackle that, we're going to have to address both reining in spending and increasing tax revenue. We have chapters written by experts on ways to do both of those things in smart, evidence-based, bipartisan ways that will rein in spending and increase revenue in ways that preserves business productivity, incentives for innovation. The second chapter of the book is about the need to build a more resilient workforce. And, we are taking up certain challenges here. First, the pandemic learning loss, the COVID pandemic and the associated school closures really set back an entire generation of U.S. school children. So addressing that challenge, bringing those kids back up to school, making the spending investments in ways that are based on evidence. Our authors call attention to high dosage tutoring in particular. That's going to be critical to getting these students who were so deeply affected by the pandemic, getting them back on track and making sure that this entire generation basically isn't straddled with lower levels of human capital.
And as a non-economist, I can say I think it's user-friendly. I mean, there are graphs in there, but not much math, and which makes it more accessible for, we hope, for policymakers. People in Washington, people who make decisions to do something about it. So let's focus specifically on one aspect, the first one you mentioned, which is the deficit and fiscal responsibility. That's very much in the news pretty much every day now. What do you have to say? What does your group have to say about what we can and should do about our fiscal situation?
Look, for a long time, there's been a general complacency about the high level of debt and the rising deficit levels in the country, largely because we were in an environment of low interest rates. Obviously, that's no longer the case anymore. And so it's important that people are now paying attention to this. I mean, we're really on an unsustainable path. The Congressional Budget Office projects that by 2053, our debt to GDP ratio will be 180%. That is far greater than any time in U.S. history. And as our author Karen Dinan writes in the volume, this poses really substantial economic risks and costs to the U.S. This will make it harder for us to grow the economy, invest in productive capital. This threatens to have lower, future standards of living for all Americans. it also reduces our fiscal capacity to address shocks we're going to get hit with in the future recessions, future wars, and it crowds out our fiscal capacity to invest in other priorities like national security, addressing climate change, as we mentioned, investing in the future workforce. And so she makes a very strong case that this is something we have to get under control. And then runs through a litany of potential policy options for doing so, while addressing or acknowledging that there are political costs and economic costs to making the necessary changes. In particular, we need to both rein in spending and raise revenue. We have two specific chapters on particular ways of reining in spending, and it won't surprise you, David, that they're both about entitlement spending in the U.S. And so our entitlement spending on Social Security and Medicare continues to take up a growing share of our federal spending. And there are good reasons why we have those programs, but we have in this volume, let's take up Social Security, for example. The Social Security Trust Fund is projected to run out in the not too distant future. And if we don't do anything about that, under current law, what that's going to mean is a 25% benefit cut for everybody. We need to get ahead of that problem. Mark Duggan in our volume proposes a series of incremental reforms to the financing and benefit structure of the program that would put Social Security on a sustainable fiscal path while preserving Social Security benefits for the non-wealthy Americans who rely on Social Security income. So there are smart ways to go about reforming Social Security. We just have to have the forward-looking leadership to implement them. We also have a chapter by the economists Owen Zidar and Eric Zwick that point out many provisions that were implemented as part of the 2017 Tax Cuts and Jobs Act. Those are about to expire. This is a great opportunity to take the lessons from the past 5 years. What did we see happen in response to those tax changes? Let's reform the business tax code going forward in ways that will raise business tax revenue without reducing business activity. And so, all of these chapters make the point that it's not just about broad cuts in spending or broad increases in taxes. There are evidence-based bipartisan ways to both rein in spending and increase tax revenue that preserve benefits for the millions of Americans who rely on government programs, that preserve incentives for innovation and business investment and growth. That's what we should be doing. Our group, the Aspen Economic Strategy Group, we're surfacing these evidence-based, sound economic ideas. What we need is forward-looking federal political leadership to implement these ideas.
Do you have hopes? I mean, you're not a politician, you're an economist, but do you have hopes that maybe a bipartisan commission, which is now being discussed, it's been proposed now on Capitol Hill, on both the House and the Senate side, we have proposals now. Do you have hopes that perhaps they could work with some of the materials you've given them and others as well to have some of these, as you say, evidence-based approaches that I must say also, it's not just what you do, but how you do it. A lot of what you're doing, you feather it in, you work it in, so it's not an abrupt change.
That's right. And these reforms really need to have bipartisan buy-in so they're lasting. We know this. Big kind of legislative changes that happen in a bipartisan way are the ones that are lasting. And we're playing the long game here at the Aspen Economic Strategy Group. We want to make investments in this country. We want to implement, or put forward policy reforms that will be long lasting, that aren't, just there until the next administration comes in and rolls them all back, or are on a short-term year-to-year basis, or, even more absurdly, just moving from one congressional crisis and government shutdown threat to the next. I love the idea of a bipartisan commission that can, put forward these ideas, as long as then Congress is willing to implement them and the administration, will back some of these really good evidence-based bipartisan ideas.
Having read it, it's a terrific volume. I really recommend to everyone. Thank you so much for bringing it to us, Melissa. That is Melissa Kearney of the University of Maryland, who is also the author of The Two-Parent Privilege. Coming up, counting your pennies. Even Warren Buffett does it. That's next on Wall Street Week on Bloomberg. finally, one more thought. Children cannot rest till they get rid of their money, or as we say, it burns in their pockets. According to the Oxford English Dictionary, that's the first reference to money burning holes in pockets, and it dates back to 1768. These days, it seems that there are quite a few children with burning pockets, starting with WeWork. Only 2 short years ago, investors, including the legendary Masayoshi Son, couldn't wait to get money into the pockets of the real estate startup. And JP Morgan couldn't wait to get tens of millions of dollars into the pockets of founder Adam Neumann to buy luxury homes.
They have a long-standing relationship with Adam Neumann himself. So JP Morgan has been leading something akin to a margin loan, where he's been taking out loans based on his private stock.
But then questions were raised about the WeWork business plan, and a massive IPO turned into a much more modest SPAC.
It had to undergo a major restructuring. Well, that restructuring has just been complete. It did go public via SPAC in October of 2021. Sandeep Mathrani took over, and he did try to right the ship.
And now even that's gone by the wayside, as WeWork made it official and declared bankruptcy this week, leaving Masayoshi Son of SoftBank about $11.5 billion lighter in his pockets.
WeWork, at its peak 2019. Here's a company that gets valued in private markets at, $47 billion. And here we are 4 years later and the company's filing for bankruptcy. And in the meantime, we know, based on reports, that Adam Neumann, the founder of the company, has managed to take in hundreds and hundreds of millions of dollars.
20 years ago, Donald Trump, long before he was president, was eager to get money into his own pockets to buy the Doral Golf Club in Florida, as well as a hotel and skyscraper in Chicago. And Deutsche Bank seemed eager to give him his wish, loaning him a total of $232 million, backed by his telling them he had assets worth $4.3 billion. A New York State judge ruled that his assets were actually worth far less. And this week, Mr. Trump appeared before a New York City court deciding how much he owes in damages, which may leave a bit less money in the former president's pockets, despite his spending much of his time on the witness stand, badgering counsel and even the judge himself. But in the end, it may all have been worth it, as Bloomberg reported this week that Mr. Trump's net worth has actually gone up $500 million since he left office. And that brings us to what may be the biggest pockets of all. We learned this week that the most famous investor of them all, Warren Buffett of Berkshire Hathaway, has amassed a record $157 billion in cash, an amount that would burn a hole in just about anyone's pockets. It appears that Mr. Buffett can't find any deals that make sense at the prices on offer, leading us to wonder how long he can wait before deploying some of that huge pile of dry powder.
I am curious about that cash pile. When do you think, Gregory, it will be the right time to really try to deploy a big chunk of that $157 billion?
But if we've learned anything at all about Warren Buffett, it's that he never feels the burn of money in his big pocket. He'd rather keep it where it is than invest in things like WeWorks or loans to real estate developers with uneven records.
I'll have a sausage muffin with egg and cheese. $3.17 is a bacon, egg, and cheese biscuit. The market's down this morning, so I think they'll pass up the $3.17 and go with the $2.95.
That's why he's Warren Buffett, and the rest of us are not. That does it for this episode of Wall Street Week. I'm David Weston. This is Bloomberg. See you next week.